has stood at the center of Philippine banking for more than a century. Bank of the Philippine Islands, or BPI, has long been a cornerstone of Philippine banking, known for its strong brand, proven track record, and consistent execution. But like many in the sector, it is feeling the impact of shifting interest rate environment. Its share price has taken a hit in recent months as investors worry about margin pressure from easing interest rates. Does this pullback present a window of opportunity, with BPI doubling down on digital, expanding its retail and SME presence, and staying focused on long-term growth? Let's find out if this is a good time to take a second look at the stock. Representing BPI today, let me call on our first speaker. We have Mr. Haj Narvaez, who serves as the head of corporate planning, investor relations, and sustainability for BPI. Prior to assuming his current role, he served as a president and CEO for BPI Securities, the stock brokerage arm of BPI. He has close to 20 years of experience in financial services, including in corporate finance and cash equities. And he previously served as head of equity research for Credit Suisse Securities Philippines, among others. Let's give a round of applause for Mr. Haj Narvaez. Our second speaker is Ms. May Taco, who is the Vice President and Head of Investor Relations and Capital Management at BPI, with leadership roles since 2021. She previously led fixed income markets and portfolio management in BPI's wealth management arm, where she spent 20 years. She began her career in the BPI Group in 1994 and holds degrees from UP Diliman, Bachelor of Science in Business Administration, cum laude, and Ateneo Graduate School of Business. Let's give a warm round of applause for Ms. May Taco.
Okay, good morning, Haj, May, and thank you for joining us today.
Thank
Pleasure.
Yeah. Okay, so let me begin by, asking this question. There's so many banks out there. So what differentiates BPI from all the other banks and all the big banks?
I think, I guess if you want to distinguish BPI, I think one, and this has been especially more pronounced, I think, in the past few years. We really pride ourselves on being the most customer-obsessed bank. You've really seen the transformation in BPI in the past few years. You see it in our culture, in our branches, the way that we have really broadened, the clients that we are now serving. No? And this pretty much is manifested even in the data that we're seeing. No? If you look at, we track what we call an NPS score, which is really a sign really of how satisfied customers are, how loyal customers are, and I think we have scored the highest there among the banks that we tracked in the past 2 years. No? So that's a sign of that. I think second, we are very much, our strategy is very much anchored on growth. No, we're going to talk a lot about margins later. No, but as you've probably seen in our first half numbers, we managed to deliver the highest or the most expansion in terms of net interest income. Our returns are likewise the highest among the top 3 banks. So I think you have a strategy that's customer obsessed and that's focused on growth. And then third, maybe what I also want to highlight is our digital capabilities. We were very fortunate enough that we made quite aggressive investments in tech, even way back, before the pandemic. We did that, focused pretty much first on the back end. So even 2016, 2017, we actually went through a lot of growing pains there. And in the past few years, we also completed the launch and the upgrade of our 7 main digital platforms. No? And these investments have served us well. No? We've been able to open more accounts. We've been able to engage more with our clients digitally. And I think both in the near term and in over the medium term. This puts us in a strong position to continue to acquire more customers and also to deliver growth and likewise returns.
I see. So speaking of the growth in customer base, you've increased it from 11 million in 2023 to 17 million today.
Yes.
And how were you able to do this? And is there still room to grow?
Yeah, well, just to highlight as well, no, we have a very aggressive target, no, and we'll probably flash it later. But when our current president, Mr. T.J. Limcaoco, came in 2021, he gave us a very ambitious goal of actually increasing our customer count from 8 million customers to 50 million. Now, we still have a long way to go, but I think it's a nice number to have. And at the very least, the fact that we've been able to double our more than double our customer count in the past 4 years is quite a feat. We've been able to do that really by, again, focusing on digital. So we're getting a lot more of accounts open digitally. And second, we've been very creative and we've been really trying to find ways to partner up with who we consider to be, strong funnels in terms of getting us to open more accounts. No? So for example, I think we were one of the first large banks to offer some of our investment products, our deposit accounts in GCash, for example. No? So really, that's how we've been able to do it. We've also, I guess we've also made it, we've been trying to make our products also more attractive to a wider swath of customers. This includes lowering the barriers to opening accounts in terms of like things such as minimum investment accounts, minimum balances that you have to maintain. And really, I think you've seen that even in the past few years. We've started to become more aggressive even in terms of marketing BPI, whether it's marketing it digitally through social media. We've really been noisier about making sure that people are aware of what BPI has to offer.
Because unique to BPI, I think, is also the agency banking. No? So where does this play a role in generating this customer base?
So agency banking was really born out of the desire of the bank to reach more customers because of what Haj mentioned, 50 million target in customer base. So what we've done is really to partner with brands that have strong presence outside Metro Manila. So that will be your grocery stores, your convenience stores, department stores, your pharmacies, including gasoline stations and even pawn shop. And some of these brands you can see on the screen. So right now we have about 25 of these brands. So what we have done is really to equip them with technology so any Filipino can go to them and apply for a BPI product. So it can be deposit, it can be credit card, it can be auto loans, it can be insurance, and so far, if looking at the chart, the red dots are the BPI branches, and the blue dots actually are the partner stores. We have about 6,600 of them as of June. So it instantly increased the presence of BPI across across the country. And you see there are a number of 300. The 300 is essentially the partner stores that can act like a branch. You can go there and make a deposit or make a withdrawal, what we call cash in and cash out transactions. So this is a way of reaching to more clients, doing more transactions without investing so much, because what we are using here are the infra and the stores and the employee of the partner store. So this one dovetails to one of our strategy, which is really, as you know, compared to the other competitor, we're keeping the number of our branches. We've slowly been decreasing it. It is because we feel that we can move some of the transactions digitally and some of the transactions through our partners in the agency banking.
So it's really geared towards efficiency, no? And also scale of distribution. Yeah.
Yes, efficiency and scale of distribution. In terms of maybe altogether, if you look at the transactions that we are doing now with the help of agency banking and with the help of digitalization, our CIR, cost to income ratio, has been going down, despite the fact that we're doing more transactions now compared to where we were back in 2021. It has more than doubled in terms of the transaction count, but the cost of doing transaction has really, in terms as a ratio to our revenues, has continued to come down, and that has also helped the bottom line or the income of the bank.
So just to clarify, so for the 6,600 stores, they can open accounts, parang ganon. Application, meaning application. And then for the 300, they could do deposits and withdraw. Is that correct?
For the 6,600 stores, they can go to the partner store, and there's what we have, a QR in that store where they can shoot that QR and they can be led to a portal wherein they can open. They can apply for a product. But for the 300 stores, then they can actually do a cash in, cash out. It's just like going to an ATM, but many of these areas where the blue dots are, they don't have ATM. So instead of doing that, instead of going to the key cities, they can go to the partner store and make their withdrawals.
Is there a plan to increase the 300?
Oh, yes. It's trailing the 6.6 because that 300, the program to convert them to a cash in, cash out facility has just started in August last year. So that will continue to increase, especially now that we're seeing more transactions are being done in partner stores that have cash in, cash out facility compared to those which don't have cash in, cash out facility.
Pretty exciting. Okay, so I mean, for us, one of the exciting things we noticed about BPI is its growing exposure to consumer loans. How are you able to do that? And is this an area that you expect to grow further going forward?
Yeah. So maybe we can go to this slide now. If you really look at it now, I think in general we've been quite aggressive about expanding our loan market share. No? So we're now at about 16%. I think we're comfortably the second biggest bank in terms of total loans in the Philippines. And I think what's been especially striking is we've managed to do that really by being quite aggressive about our, growing our exposure in generally the consumer space. No? So this year, I think we've already grown about 27% year on year, and it's been much faster than the growth we've seen in the corporate side. It's really a function of several strategies. I think one, we took quite a hard look at how we were dealing with clients, in terms of the types of facilities that we were giving them. So, for example, I think on the credit card side, we saw that there are really ways for us to engage better with clients, to, I guess, kind of improve on the type of facilities that we were giving them. So we saw that with credit cards. We made a lot more investments on the marketing side, making sure we kind of tied the rewards with, activities that clients like to do, for example, in the credit card space. I think typically what you see in credit cards, for example, is a lot of people like to use it for dining out, for travel. So we made sure that, I guess, rewards were kind of tied to that. On the auto loan side, and I think even on the mortgage side, we really tried to reduce the amount of time it took to get loans approved. No? So typically now, I think especially on the auto loan side, it takes about a day or two to get your loan application approved. And it's really helped us as well, not just with the clients who apply through the branches, but even working with the various dealer networks, those who actually sell cards. And I think third really is broadening your base. No, we're targeting a larger swath of clients now. So typically in the past, no, I'd say perhaps we were a bit more focused on kind of like the affluent clients. I think we have, I think slowly, and you'll also see this in our deposit numbers. Really, we are acquiring a lot more clients, especially in what we call our core mass and our mid market. Those who open core mass and mid market accounts.
And what about the growth outlook? Can we still see more, or do you feel like you've maxed it out at this point?
I think the growth outlook, I think we're still quite constructive. No, you saw that in the first half, we managed to grow our loan book by about 14%, and that was against a backdrop, I would say, of a more higher interest rate environment. And obviously, interest rates have slowly come off. I think the expectation is that over the next 15 months, you'll probably be getting somewhere between, I would say, 1 to 3 more rate cuts. No, so our sense is that the type of loan growth that we are seeing now for BPI and in general for the banking sector will hold. I think loan growth of about 12 to 14% is quite achievable from my vantage point now. And I think generally the trends that we've been seeing, which has been strong consumer loan growth, especially for us, will continue to hold. We're still quite bullish about certain parts of especially the consumer loan base. Erwin alluded to earlier, Erwin of SM alluded to earlier, but there's still a long way to go in terms of consumer loan growth. If you look at consumer loan growth to GDP, it's only about 12%. Even other developing markets, some of our neighbors, Indonesia, Vietnam, already are ahead of us in terms of consumer loan growth. I think they're at least about 16%. So just taking that in, you have at least 33% growth just to catch up with them. I think I would add that the interest, the lower interest rate environment will help. I think it will help make loans more affordable. I think it will not only help consumers, but even help on the corporate space. I think generally, over the past 12 to 18 months, it's been a bit more difficult in that space, given some of the uncertainty. You had a lot of volatility when it comes to exchange rates, tariffs, the cost of importing. But I think slowly we're seeing more and more stability there. And the fact that interest rates are going down, I think it's going to make a lot of the decision makers a bit more comfortable to make bigger calls in terms of investments, in terms of capex. And with interest rates kind of stabilizing or at least going down at the very least, it kind of improves or increases the attractiveness of projects. So we expect, I think there's even potential for corporate loan growth to accelerate from the 8 to 9% levels that we've seen in the past 12 to 18 months.
So, yeah. Charles, you have a question?
Yeah, so, okay, so, but the flip side to that, okay, at least in terms of the concerns, is that the lower interest rates could impact the margins of the bank. No? So, just for the benefit of our audience, no, so the margins would be the difference between what you're lending out and versus what you're paying the depositors or the funding, right?
Yeah.
So, could you comment on the outlook for margins for BPI?
So generally, the way you should look at, when rates are going down, immediately it should actually be good for the banks, because I think typically deposits will reprice ahead of loans. So typically you have a lot of time deposit accounts that usually have a maturity of 1 month. So typically those will immediately reflect the change in policy rate. But maybe it's important to highlight, I'll just direct you towards the right-hand slide here, no? And what you'll actually notice is that our NIMs, or our net interest margins, basically what we make from our investments, from lending out money, the margin has actually increased versus our cost of funding. No? As you can see here, no, our NIMs are actually up over 30 basis points on a year-on-year basis in the first half. No? And that's really a sign of, I guess, how successful we've been in terms of navigating this lower cost environment, lower interest rate environment. No? And that's really a product of our strategy to really focus more and more on non-institutional, or what is majority of which are consumer loans. Typically, consumer loans, they are not as sensitive to movements in interest rates as compared to corporates. Second, I think as I've alluded to earlier, we've been growing quite quickly in terms of the book. The first half we grew about 27%, whereas corporate loans only grew 9%. So as the weight, or as the share of consumer loans in terms of our overall portfolio expands, that also increases our margins. No? So just to give you, not to bore you with too much with numbers, no, but just to talk about sensitivity. No? Typically, our view is that every 25 basis point move in policy rates typically has an effect of about 4 to 5 basis points on our net interest margins. So if you're looking at anywhere from 1 to 3 rate cuts in the next 15 months, that could have an effect of anywhere from 4 to 15 basis points in terms of our net interest margins. But fortunately for us, if we continue to grow our consumer loans, let's say over 20%, and corporate grows, let's say 9 to 10%, we're able to grow our consumer share in terms of our loan mix by about 2 to 3 percentage points per year. And the effect of that is, I would say, anywhere from about 10 to 18 basis points in terms of our net interest margin. So the 10 to 18 basis point uplift in our margins pretty much will cover for even the most aggressive scenario where policy rates are cut another 3 times over the next 15 months. So I would say I would expect our NIMs to hold up, and so I think generally that should be good for all things equal for returns on equity as well.
Okay.
Just quickly add, no, kasi one good thing about BPI is that you have, relative to the other big banks, you have the largest consumer loans as a percentage of total loans, right? At 28%, is that correct?
I think we're now closer to 30%. So actually, in terms of our strategy, when we crafted our medium-term strategy, or an update on our medium-term strategy in 2021, our goal was to get to 30% by 2026. We're actually already there.
But at 30%, are you happy with that? And you're just going to keep it at 30%, or are you open to increasing it even more?
I think we're still we haven't updated that yet, and obviously we're there already in terms of achieving our goal. I think all things equal, and again from my vantage point, given we have a very low consumer loan to GDP ratio, I think the arrow is still pointing up there.
So, since a while ago, I asked this from Erwin in SM. And I'll ask this to you because you are a bank. So, especially now you're expanding your consumer lending. How do you actually identify, new borrowers that you can lend to? Because it seems underpenetrated, or existing borrowers who are a good credit risk and you can lend money to, because again, you've successfully grown your consumer lending.
We're very fortunate that we have a fairly big deposit base, right? We have as I said, we have 16 million. We have 16 million customers. Most of them are depositors. We're fortunate that when you look at the makeup of our deposit mix, about 2/3, I would say there's about a 3:1 ratio in terms of retail versus non-institutional, in terms of the mix of our asset base. So that really gives you a big, a very deep pool of customers that you can potentially acquire as borrowers. No, so there's been some, there's been a lot of talk about asset quality, but what I do want to highlight is that a lot of our growth really is coming from people who are already existing depositors. No? So we've done a fairly good job of mining these customers. No? So, aside from, I guess, traditional ways of looking at credit, you look at, let's say, income, you look at inflows into their accounts. I think one thing that we also do is we use a lot of data. No? So we identify, even before we target certain customers that we want to lend to, we try to identify, what type of customers are actually probably going to amount to being good credit, who are the types of customers we should be lending to. So we leverage a lot on our data. So I guess part of the growth also, and one thing we've been quite successful at, is really running tests in terms of identifying, who would be potential customers. Now, I want to assure you though, is these tests are very, are done in a fairly small scale. And we also make sure that we try to balance out how aggressive we are and try to make sure that we don't, we make sure that we limit it in terms of the number of customers that we're targeting. So, in case there are potential, there's a potential increase in terms of the stress levels that we're seeing with those accounts, it's going to be managed and we're going to be able to, close those issues very quickly. So I guess, yes, it's been a combination of being more aggressive in terms of use of data, in terms of identifying the types of customers that we want to lend to. But maybe also what I want to highlight is also the one thing that you get as you get more aggressive in terms of targeting clients and offering new products is you really learn more about these customers. No? And I think one thing we are doing is really refining everything from our collections, from our credit processes in terms of, and even the types of credit facilities that we offer clients. The fact that you get more experience with clients, you learn more about customers, I think only makes your credit underwriting process stronger.
I'll shift a bit at this point. No? So last January 2024, the merger with Robinsons Bank took effect. So my question is, how has this merger impacted, affected BPI? And maybe you can talk about potential, has there been synergies with the Gokongwei Group?
So I think we have a slide on that. So the merger took effect January in terms of integrating the people. We're done with that. With the merger, we acquired about 158 branches of Robinsons Bank. We're integrating half of that to BPI, and the rest we will be consolidating or collocating with existing BPI branches. In terms of synergy, what we have talked about during our earnings call is we acquired two products with RBC because of the merger. One of them is what we call motorcycle loans. We didn't have that because we tried that before in BPI, but we let go of it because the scale is really very small, and it will require you to work closely with the dealership. And we didn't have that scale, but since RBC has that, we have acquired that, and that portfolio has grown to 5 billion pesos as of June, and it has grown to close to about 30% since the time of merger. And another product that we acquired from merger is what we call teachers' loans, and we have a slide on teachers' loans. We didn't have, to lend to teachers. These are public school teachers. You have to have an accreditation, and we don't have that license or accreditation. But one of one of the subsidiaries of Robinson's, what we call Legazpi Savings Bank, has that accreditation. So we acquired it, and that portfolio has grown to 12 billion. We have grown market share to close to 6%, whereas before it was just 3%. Now it has grown a lot because from 27 branches of the Legazpi Savings Bank, we are now using close to 1,200 branches of BPI. So the growth potential is there because we estimate that the total loans for teachers is about 5 billion or 500 billion pesos, and we're not anywhere near that yet. So, other than that, we have onboarded a lot of suppliers of the RRHI and JGS. We've seen growth also in terms of the business that they've given us, in terms of forex, in terms of cards, in terms of wealth management. So that should continue moving forward.
Okay, so a while ago when we were talking about consumer lending, you talked about asset quality, no? And I think that's one of the concerns investors have about BPI, especially as provisions increase significantly during the first half. Maybe you can provide us some insights into your asset quality and the reason for the increase in provision. Is that something that investors should be worried about?
Okay, so maybe I can start and then maybe Haj can add. So in terms of asset quality, we've seen uptick in our NPL, and that is understandable because as we've said, we've increasing our exposure to consumer. So all things equal, then we should expect an increase in NPL. And then one of the concerns also is there has been a decline in the NPL cover. It's now down to 97% in terms of total. So what we've done actually is to show the cover per product. And as we have a slide on that, but for say unsecured loan segments, which is your personal loans, your credit card, your personal loans and a credit card, you'll see a cover of more than 100%. But for those segments like auto and mortgage, we will have less than 100% cover because these are really collateralized. So when we look at it, of course, there's also concern that the provisions has increased as mentioned by April. But when we look at it, we look at all, yes, provisions on one side, but then there's also revenue on the other side. So we add up all the revenue that we get from interest income, not just interest income, but also from other fees that come with a higher loan volume. So that will increase for credit cards. That may include your annual fee income, your income every time they make transactions, your application fees if these are auto loans. So all in, we compared revenue together maybe with the increase in provisions or maybe NPL formation, net of recoveries. And as long as we see that the revenue pretty much, much covers or more than covers what we see in the provision, then I think we're on the right track in terms of how we're the thinking behind the continued growth in our consumer loans.
So maybe just to add, no, I think one way, and I think you can also, I would suggest to look at it is you look at because I think when you look at that shift to consumer, right? Obviously you get a revenue uplift, but then you also get, because really the default rates in consumer inherently are higher than corporate, no? So I guess you have to look at it holistically, what is the revenue uplift or margin uplift you're getting versus what you're getting or what you're losing out on in terms of having to come up with more provisions, no? And I think you can look at BPI, you can look at how other banks fare. I would say that even if you adjust our margins to capture the change in risk or the change in provisions, what you will still see is that we are, we've been able to manage that that margin even in light of the higher provisions, no. So, in effect, it hasn't been really a drag on our. I would say it hasn't been a drag on our profitability.
So in other words lang, no, just to, I guess, to phrase it this way, no? So it's more manageable, both manageable and in a way also a strategic decision, no, to really, because you're focusing on consumer loans rather than a structural concern about the, the asset quality or the creditworthiness of the country.
Yeah, I wouldn't say it's that. And I think what I want to highlight now, I think moving forward, we've talked a lot about interest rates. I think all things equal, I think what you typically see is that, unless there's a major issue, there's a major event that's going to lead to the economy slowing down a lot quicker, lower interest rates in general should be good in terms of the effect on NPL formation, though. So, aside from maybe potentially some pressure on margins of certain businesses, what you'll also see really as an offset or a counterweight for that is that I think you will see potentially some more stability or potential movements downwards in terms of formation of new NPLs.
Yeah, and I also want to highlight that, for example, last year I noticed that your provision level went down.
Yes.
It might also be a function of that this year it's...
Yeah, it's more like a function of where you are coming from, right? Part of the reason why our provisions really went down significantly in 2020, or in quite, I would argue, lower levels in 2023 and 2024, so we had such a big buffer. So what you're seeing now is more of a normalization of provisions.
Mm-hmm. So I'm just curious, based on the first half provision level, as a percentage, say, of total loans, is that something we can expect going forward, or do you expect it to still go up?
I think generally what we've said is that, credit costs, you're probably looking at like 65 to 70 basis points. So pretty for the full year 2025, no, as a share of loan ADB. So not far off, I would say, from the first half levels, no.
Okay, so probably more normalized growth next year, in line with...
Yeah,
maybe
the sharpness of the move perhaps is what maybe investors noticed. I wouldn't expect such a sharp, this year is, in a way, is different because the past 2 years has been quite low given the high cover that we were coming from.
Okay, so since we're out of time, maybe you guys have closing thoughts?
Yeah. Well, apologies, I wasn't able to greet our audience earlier, but I'd like to thank you again for attending this event and giving us your precious time over the weekend to listen to our stories and I guess to allow us to share our outlook. I think moving forward, no, we're quite we're quite optimistic. We continue to remain optimistic about the outlook of our businesses. As I mentioned, we expect I think loan growth to remain quite strong, no, over the near term. We managed to grow 14% in the first half. I would say, that's kind of at the top end of our range in terms of how we're looking at loan growth in the near term. We think we can keep margins, our net interest margins where they are, and I think what's really going to help is the fact that we continue to grow quite aggressively in the consumer space. And I think again, if you could take away anything, or if you could have a lasting, 3 key takeaways as in terms of how you can look at BPI as a business or how you would profile BPI. I think one, we are a customer-obsessed bank, and I think that's seen in the numbers we're seeing in terms of our customer growth and in terms of the satisfaction scores that customers have been getting. We're a bank that's focused on growth. We're going to continue to target growth in accounts and growth in terms of the transactions that we do with clients. But we're going to balance that growth with also efficiency. So the fact that we are we made the investments in digital and we continue to invest, I think is going to help us in terms of an efficiency standpoint. No? So we managed to generate 15%, generally close to 15% ROE in the first half. And that's something we're going to continue to target in the near term. No? And I think what you've seen is that the bank has been able to grow its revenues much more aggressively than the growth in overall costs. No? So we're going to continue to focus on that. And again, so thank you very much. Thank you, Charles. Thank you, April, for your time.
Okay, thank you, May.
Thank you, thank you.
Thank you.
Thank you so much.
All right, thank you to our speakers for sharing your insights about BPI. Okay, so to wrap up our final company discussion, let's see what our moderators would like to say about the company. Miss April.
Okay, so for BPI, well, I think as discussed earlier, you talked about concerns about margins being one of the reasons for the share price going down. But again, BPI showed that their margins actually weren't going down. This is because of their, the margin pressure is being offset by their growing exposure to consumer lending, which is good. And I think at least they addressed the issue about non-performing loans and how, part of the increase in provision is not because they're really, suffering from a sharp increase in NPLs, but more because, a function of coming from a low base last year and also, their greater exposure to consumer lending means that it's inherently riskier, so they have to set aside more provisions. But of course, the focus should be on the overall growth in revenues, which is net positive. So yeah, I mean, those things said, it seems like, I would say the sell-off of BPI seems like a good opportunity. And maybe you can talk about valuations, Charles?
Yeah, so with the recent sell-off, so the valuation's now down to 1.2 times book. So I believe that's very reasonable for BPI, especially given its profitability of 15%. So I think for me, what's most important is they address the two biggest concerns that the market, I think, has currently, which is the interest rates, potential decline in interest rates, and also the asset quality, so the NPLs. I think they addressed that. They've talked about how it shouldn't be that big of an issue at this point, and also that there's growth ahead, right? There's still structural growth that they could see, both in terms of higher loan growth, higher revenues, and at the same time, efficiencies, cost efficiencies going forward.
All right, thank you, Miss April and Charles. And with that, we conclude our company discussions for today. Let's give a big round of applause to all our speakers and moderators for sharing their time and insights with us.